Hi, everyone. Thanks for joining us for this quarter's presentation. Over the next 20 minutes or so, I'll be walking through the state of the closed-end fund market, as well as providing an update on the performance and positioning of our tactical income strategies that extensively utilize closed-end funds as part of their tactical asset allocation. If you do have any additional questions or would like more information on our tactical income strategies, feel free to reach out to a member of our advisors services team. We'll have all that contact info available at the end of the presentation. So with that said, let's go ahead and jump right into things. So to start with universe-wide discounts, during the quarter, discounts narrowed by just over 30 basis points, which was largely fueled by the risk-on rally that followed the Liberation Day sell-off. As a result, we saw the greatest movement in discounts for equity funds, with U.S. fund discounts narrowing by just about 100 basis points, while international equity funds discounts narrowed by 40 basis points. If we focus, however, on international funds, we've seen pretty significant narrowing over just the last 6 months or so, as non-US stocks have outperformed the S&P 500 by a pretty wide margin. Coming into the year, we had the average fund trading at a discount of about 11.5%, only to end the quarter with an average 7.69% discount. Now, discount action was kind of mixed across fixed income. So we had taxable bond discounts move out a bit from the end of Q1 as spreads were pretty volatile during the quarter, while those still unloved municipal bond funds saw their average discount narrow by just about 40 basis points. Now, on this slide, we see just how the discount environment changed on a quarter-over-quarter basis, which for the most part was pretty benign. So if we start with the chart on the right, we're going to find that just about 79% of the universe is trading at a discount to NAV, which pretty unchanged from last quarter, and it does still track marginally above the long-term average, which is just about 76%. And then if we look to the distribution on the left, you're going to get a little bit of a better picture of how universe dynamics change. So more specifically, what you're going to see is that the distribution did shift a little bit to the right. And this is going to be largely driven by that discount narrowing that we saw out of equity funds on the quarter. So to switch gears a little bit, here we're going to take a look at some of the key drivers of closed-end fund discounts. And we're going to start with interest rates. So interest rates and closed-end fund discounts, they do tend to exhibit a negative correlation, which just means that when rates decline, closed-end fund discounts tend to narrow, and then when rates rise, they do tend to widen. And this does typically occur with just one caveat. So when we do have rates decline due to an event of extreme market stress, so think the COVID pandemic or the financial crisis, you do tend to see that relationship turn a bit positive. And just to expand a bit, so what we're looking at on this slide, we're looking at the yield on the 10-year US Treasury, that's in blue, and then the average muni bond fund discount, that's going to be in orange. So here we're using munis because they do tend to carry a little bit more duration, tend to be more interest rate sensitive than the taxable side of the closed-end fund market. We're going to look at that in a minute, but they do tend to be a little bit more credit oriented. So now looking at Q2 in particular, so in Q2, rates were pretty volatile, but generally unchanged for the most part. So we had the 10-year starting and ending the quarter with a yield of right around 4.2%. And as a result, we saw some marginal narrowing in discounts from muni funds. But as a whole, discounts for the asset class, they do continue to trade a few percentage points wider than their fair value. Next, looking at the relationship between discounts on taxable bond closed-end funds and credit spreads. So spreads on the quarter were generally flat despite gapping out to about 450 basis points following that Liberation Day tariff announcement. However, they did narrow pretty quickly. So we ended the quarter at less than 300 basis points over treasuries, and that's compared to a long-term average of about 500 basis points. And I think it's really this volatility that led to some of that slight widening within taxable bond funds for the quarter. That said, though, the average taxable bond fund, it still does trade at a pretty lofty valuation with a discount of just 1.5% below NAV compared to a long-term average that's going to be closer to 4. And then lastly, here we see the relationship between equity market returns and broad closed-end fund discounts. And in terms of this relationship, behavioral finance, or really the tendency for investors to over and underreact, is going to play a pretty primary role in driving closed-end fund discounts. Because as many of us know, the closed-end fund market does tend to be very retail-driven. And that's exactly what you're going to see on this chart. So declines in equity markets and high volatility environments, they do tend to cause closed-end fund discounts to widen. And then conversely, periods of strong returns or low volatility do tend to cause discounts to narrow. Now, I think we saw this precise relationship on full display in Q2. So equity markets rallied meaningfully from their near bear market decline back in early April. We also saw the VIX fall from a high of more than 50 back in April to just about 17 at quarter end. And as a result, we did see a pretty meaningful decline in equity fund discounts, and we discussed that a little bit earlier. So taking all this into account, let's look at how these market dynamics have impacted the performance and positioning of our flagship closed-end fund strategy, TICE. So first looking at portfolio attributes, our closed-end fund exposure didn't change on a quarter-over-quarter basis. However, there was a bit of trading that occurred within the portfolio, particularly around that volatility that we saw back in April. The current mix, which is currently split evenly between closed-end funds and ETFs, that's going to be really a reflection of current opportunities within the market, with the average fund basically trading right around its long-term average. Now, from a discount standpoint, at quarter end, we saw our average closed-end fund holding trading at a discount of just over 8%. This is about 60 basis points more narrow than where we ended the prior quarter, and this was clearly additive to performance, something we're going to see in a couple slides. And then as of quarter end, TICE was offering investors a distribution yield of 5.18%, which is up just a tad from the end of Q1. Now to speak to where we're finding the greatest opportunities. Here we're looking at the closed-end fund versus ETF breakdown for each sleeve of the portfolio, along with the average discount of that sleeve. And what you're going to notice is that we're clearly finding the least opportunity in U.S. equities and taxable fixed income, with a 69% and 68% allocation to ETFs respectively. For U.S. equities, relatively unchanged here. This has been relatively high for much of the last year plus, as discounts never really gapped out for equity funds on a relative basis, at least. However, I think one key observation to make in regard to our U.S. equity allocation is that despite the universe not looking great as a whole, the funds that we are invested in are trading at pretty attractive discounts, with the average fund trading at a discount of more than 11% below NAV at quarter end. Now, taxable fixed income also saw little changes throughout the quarter, with discounts trading so narrow in that space. However, similar to U.S. equities, the funds that we do own are still trading at pretty attractive valuations. There we've got an average discount of more than 8%. Now, on the flip side of that, we're still finding a good deal of opportunity in our municipal bond sleeve. So here we have a 100% allocation to closed-end funds, with the average fund trading at more than 7% below NAV. Now, being 100% allocated, we don't have room to add to our allocation here if discounts do continue to widen. However, we could easily swap into more attractive funds should we see some type of disruption in this space. So next, taking a bit of a deeper dive into performance for our TICE strategy. On this slide, what we're doing is essentially decomposing the strategy's returns into the three core building blocks. So we have capital appreciation, dividend income, and then what we refer to as closed-end fund alpha. So in Q2, we saw positive returns from the strategy, gaining 4.41% on a net composite basis, with returns largely coming from capital appreciation, as both stocks and bonds performed pretty well in the quarter. You're going to see a positive 132 basis points coming from yield, and then we have closed-end fund discounts, or that closed-end fund alpha component, contributing 52 basis points. And I think this slide gives some really good insight into the benefit of using a strategy like TICE, where you've got the potential to benefit from multiple sources of return, and in particular, that unique closed-end fund alpha component, which isn't going to be accessible to traditional mutual fund and ETF investors. And then this is translated, as expected, into some pretty strong relative returns over just about all periods. So near term, we've got the gross composite ahead of its benchmark by just over 40 basis points on a year-to-date basis. And then over the long term, we see outperformance of 325 basis points annually over the last 5 years, and then 170 basis points annualized since its inception in October of 2016. And then just to hit on risk from a risk standpoint, since inception, TICE has exhibited a standard deviation that's a bit higher than its blended benchmark, which this is largely going to be driven by the higher volatility of nature of those closed-end funds. However, looking at performance, investors have been amply compensated in the form of those excess returns, as we just talked about a minute ago. So now to switch gears for the rest of the presentation, we're going to talk about our TICE Alpha Opportunity Strategy, or TAO. And for those who aren't familiar, just a bit of a refresher. So TAO is a unique set of strategies that combines our TICE closed-end fund alpha strategy with a portfolio of undervalued assets. So we're going to refer to them as high conviction tactical assets. Now, everything that we've talked about so far, that's going to apply to the first half of the portfolio, which is just essentially an asset-weighted version of our TICE portfolio. But what I want to do in the next few slides is to touch on where we're finding value from an asset class standpoint for the second portion of our TAO strategies, and then how all of this has translated into performance. So starting with our long-term return expectations, the order here hasn't changed, but we have seen some marginal deterioration in U.S. equity market expectations with that strong rebound that we saw from those April lows. So as a result, our expectation for growth stocks, that's ticked down to just 0.56% annual over the next decade. And then U.S. large cap stocks, that's moved down to 2.5%, both of which are obviously well below what investors have experienced historically. Then if we dig a little bit deeper into the U.S. Value stocks, there we have a return expectation of around 4.5% annually over the next decade, so a clear improvement over their growth peers. And then we have small caps, which are slightly higher than U.S. value stocks, but just keep in mind that small caps do come with significantly more volatility. So there may be an opportunity here at some point, but we don't think we're there yet. We need to see valuations gap out a bit more. And then we have our standout non-U.S. equities on the far right with double-digit returns, and this comes despite that strong outperformance that we've seen so far in 2025. And the big driver of this differential is largely going to be valuations and currencies, both of which favor non-U.S. stocks over the long term. Then if we look at the fixed income side of the market, we still have EMD with outsized return expectations. This is coming due to a combination of their attractive yield as well as exposure to an undervalued currency basket, while most investment grade fixed income asset classes are expected to return kind of in that mid to low single digit range. And the largest change here, that's kind of been that shift between short and long-term treasuries. So now we have longer dated bonds expected to return close to 5%. This is largely coming as the yield curve has disinverted for the most part over the last year and a half or so. And then the way this all translates into the portfolio's asset allocation, that's what we're looking at on this chart. So on the equity side of the portfolio, you're going to find our largest allocation of 55% and 30% to emerging markets value and international value, respectively. And then you're going to see commodities with a weight of 15%. This is relatively unchanged since last quarter. And then on the fixed income side of the portfolio, we've got a little bit of a barbell there. So you're going to see EM local bonds, that's your risk asset on one side of the portfolio. That's going to be balanced out with an allocation to short-term and long-term U.S. Treasuries. And that long-term Treasury position, so that is new. That was implemented during Q2. Reason being is that shifting shape in the yield curve that started to take a little bit of a shine off the front end of the curve. Now, getting into our rationale for our high conviction assets, so I'll go ahead and start with non-U.S. value stocks. Major story here is valuations and currency. So on this slide, we're looking at valuations through the lens of price to trend line earnings ratio. And what's compelling is really what we see from both emerging and non-U.S. value stocks. Now on the developed side, and here think Europe and Japan primarily, valuations look to be near historic lows, meaning that we're likely to see a positive contribution to future returns from PE multiples. This runs pretty much counter to the U.S. where valuations are likely to cause a meaningful headwind as we look ahead. And then you're going to see similar results in the EM value space where relative to the U.S., they trade near an 80% discount, which is pretty much right in line with their cheapest levels that we've seen in the last 25 years. And then there's the dollar. So this has been a massive headwind for non-US assets, not just over the near term, but over much of the last decade. In fact, as we were coming into 2025, dollar strength had actually detracted about 200 basis points per year from US investor returns in developed markets equities and nearly 250 basis points from US investor returns in EM equities. That said, though, we have seen a meaningful reversal so far in 2025 with the Bloomberg Dollar Index experiencing pretty close to a near 10% peak to trough decline from its January high. So some potential explanations for this include increased lack of faith in the U.S. amidst all the trade uncertainty, as well as foreign investors moving assets out of U.S. markets into their own markets, both of which really speak to those sharp moves that we've seen recently. Now, if we look at valuations for the dollar, which is what we're looking at on this slide, regardless really of what metric you look at, the dollar looks relatively expensive today. So here we show valuations through two different lenses. We've got a simple price trend valuation and then purchasing power parity. And what you're going to find is that on both metrics, the dollar looks about 20% overvalued, or conversely, non-US currencies look about 20% undervalued. So if we see mean reversion just back to some reasonable level of fair value over the next decade, you've really got the potential to see an additional 2% return on top of the fundamentals such as dividend income, earnings growth, and then additionally any change to those PE multiples. And then moving on to fixed income. So emerging markets local bonds have been a standout performer this year. So we've seen gains of about 12% on a year-to-date basis. And those returns have really come from a diverse set of performance drivers. So if you look at just price and income returns, you're going to see gains of just over 5%. So just a tad better than what we got out of U.S. investment grade bonds. But if you add in the currency impact, that's really where you find the greatest contributor to excess returns so far this year. So over just the last 6 months, the dollar's depreciated by about 6.5% versus the basket of EM currencies. And since we're US based investors and these bonds are denominated in local currencies, this change in currency values is going to go directly to bottom line performance for the asset class. Now, question is, can this continue? And we would say yes, there is a good probability that it can. So if you look on the left pane of this slide, we have a potential annualized return over the next 6 years of just about 9% annualized. Now, a good part of this comes from the yield on those securities, which still stands at pretty close to 7%. But you also see a large contribution expected to come from currency appreciation versus the dollar. So even with the run that we've seen over the last 6 months, EM currencies continue to look meaningfully undervalued versus the dollar. And even with just simple mean reversion back to the mean or fair value, they could contribute an additional 2% per year for the next 6 years and possibly more. And then lastly, here we're looking at the current shape of the yield curve, which has seen a good deal of normalization in just the last year or so. Now, if we look back to just 2023, we had the slope between the 2 and the 10-year Treasury trading near 100 basis points inverted, implying that you got about 1% more in yield from owning short-term bonds versus the longer end of the curve. Great time to own short-term bonds, given the slope between the 2 and the 10-year typically trades around 90 basis points upward sloping. This has been slowly unwinding or disinverting over the last year and a half as short-term inflation expectations have come down and the Fed has started cutting rates, although they have paused so far in 2025. So what implications does this have for investors, I guess is the question. Well, what it does imply is that today isn't a bad time to think about adding some duration back to your portfolio, which is exactly what we did in Q2. As that curve normalizes, even though we still have a little way to go, not only do you now have a positive carry at the longer end of the curve, but it also provides room for rates to decline and act as a potential ballast in times of market stress. So just to finish up the last couple slides here with some attribution and performance. So here you're going to see recent performance of our high conviction asset classes compared to their policy benchmarks. On the equity side of the portfolio, our Tau strategies did very well versus their policy benchmarks in the first half of the year. This was largely driven by the divergence we saw in global equity performance, which was fueled by strong performance out of non-US stocks and that meaningful weakness in the dollar that we've talked about already. Commodities, slight detractor, although performance is positive on a year-to-date basis. Big thing that weighed on commodity prices in Q2 was all that uncertainty that we saw in the Middle East, which really weighed on energy prices. Now, our fixed income assets also outperformed their benchmark. So this was largely driven by EMD performance, which gained 7.62% during the second quarter alone. You're going to see long-term treasuries down a bit on the quarter, but keep in mind that we didn't add this exposure until mid-May, and long-term treasuries have actually performed quite well in the near term, gaining 2.5% in June by itself. And then finally, performance. So on a year-to-date basis, this is all translated into strong results across the board for our gross composites. So closed-end fund performance, a little bit mixed. So it was really our high conviction equity and fixed income assets that have propelled the strategies past their benchmarks. Now, if we look since inception, so that goes back to April of 2020, our income ops or our 1090 strategy has gained 5.74% annually compared to a 1.71% gain for the blended benchmark. Performance there has been supported by our closed-end fund alpha sleeve, which added pretty meaningfully to returns over just about every period except 2022. And then in addition, we've seen value added by our short treasury and EMD position, especially lately, and EMD in particular over the year-to-date period. And then the opposite end of the spectrum, if we look at our most aggressive model, our Tau 80/20 strategy, you're going to see excess returns of 157 basis points annually over the same period. But unlike income ops, this was largely driven by our positions in commodities and non-US value assets. So they provided a pretty significant level of downside protection in 2022 sell-off. And then in addition, we've seen that really strong start for non-US stocks so far in 2025. And I think all of this just really highlights an important component of Tau, and that's its ability to benefit from these different sources of returns. So you have your closed-end fund alpha and you have your undervalued assets, and they tend to run in varying cycles, and this really helps us to provide competitive results across a variety of market environments, which is precisely what we've seen in practice here. So with that said, that concludes all of my prepared remarks for the presentation today. Like I said at the opening of the presentation, if you do have any additional questions or if you'd like to get more information on our tactical income suite of strategies, please feel free to reach out to a member of our advisor services team. You can see our phone number there. You can also visit us at icm-invest.com. Thanks to everyone for joining us for this presentation, and I will see you next quarter.